everyone, this is Kevin Zhao, your professor at MTSU. In this video, let's go through chapter 22, valuing firms with the negative and the abnormal earnings. This is the second chapter that we're going to cover for this week. Okay, let's take a look at what are major causes for abnormal earnings. Abnormal earnings could be negative numbers, a low number, that you observe for a company. So if the past year earnings is negative, then how do you estimate the future earnings, the future cash flows? And before we do any estimation, what we needed to do is to examine the root cause of those negative or abnormal earnings. And essentially, you can distinguish two different types of problems the company are facing. The first one is temporary problems, and the second one is long-term problem. And the different problem will lead to different solution and different estimation methods. Okay, so if you found that a company is facing a temporary problem, which may be caused by three different perspectives. The first one is the firm specific events, which lead to temporary problem. Let's say a company CEO is sick in the hospital, right? And the company operation may be negatively affected, and in this case, it's a very typical firm specific event. And the second type of problem will be maybe caused by sector or industry-wide events. In this case, a certain event in the industry may negatively affect the entire industry, not just the one specific firm, but basically all firms in that sector or industries. For example, let's say there's an earthquake in Japan, and this event actually caused the shutdown of the supply for many materials in semiconductor industry. In that case, the damage from the earthquake will negatively affect the logistics and the supply chain of not only the manufacturer of semiconductor providers, but also the entire industry of semiconductor, because the supply chain has been disrupted, and the effect may last for a couple of months, but it's not a temporary problem. The problem can be solved in maybe several months. So this is a typical case for industry or sector-wide events, which may lead to temporary problems in a firm. And the third one is pretty common, the cyclical nature of the problem. And a lot of businesses, especially pro-cyclical businesses, may be negatively affected by the recession and the slowdown of the economy, and their business are more sensitive to the business cycle. And company's earning may turn negative, and the company may go through a very difficult time when recession hit the economy. But the recession will not last forever, and when economy began to expand, then those cyclical businesses, the operation in those cyclical businesses will get better. So that's another temporary problems. So those are three sources of temporary problems that a company may face when they have negative or abnormal earnings. And the second type of problems are long-term problem. Please keep in mind that if a company has a long-term problem, then the analysts need to be realistic about the future of the company, because most long-term problems cannot be fixed in a very short-term time period. So when you do earnings adjustment, you need to be realistic about how bad scenario will be for a company. So here are four basic reasons for long-term problem that a company may have. The first one is problematic business strategies. So if a company is on a wrong path for their business strategy, then you would say, hey, the company will never have a bright future. And here's one example. Let's say bookstore that have physical operating locations. Right? And during the last 10 or 20 years, those bookstores are facing tremendous challenges from online booksellers like Amazon. And if the company continue to increase the size of their business operation by opening new bookstores in new locations, trying to capture market share or increase sales, then it would be a very problematic business strategies because physical stores for book selling uh, cannot compete with online book selling. And if you expand physical locations trying to compete with online retailers, then it's not like it won't be a successful business strategy. So this is just one example. So if analysts found that a company is having a problematic business strategies, then you need to be realistic in adjusting your expectation on company's operating performance in the future. Right? And this is a long-term problem, and it's very likely cannot be fixed. And the second one is inefficient operation. And when you conduct financial analysis, found that financial matrix regarding operating efficiency for company is lower than the industry average or lower than historical records. And if it's a large company, then you need to be very careful to make an adjustment on its future perspective because inefficient operation is unlikely to be improved, especially in a large company because of bureaucracy or poor management operations. So if you found that a company has inefficient operation, especially in a large firm, then you need to be realistic because that kind of problem. I mean, it looks inefficient operation can be improved if you improve your management, but it's easy to say that down. And in large companies, unless you change the business, unless you change the entire business management team, it's unlikely that inefficient operation can be improved drastically to bring the company out of its deep trouble. So that's a second reason for long-term problem. And the third one is a high leverage. If a company currently have high leverage, it's unlikely that a company has a capability to lower leverage towards industry average or lower than industry average in the short term because if a company is in deep trouble, then how can company uh, generate cash flows to pay out debt? Right? And the only way company can survive could be even borrow more money and increase leverage, which will make the problem even worse. So high leverage is another long-term problem that the company may not be able to fix in the short term. The last one is life cycle of the industry. You look at life cycle of the industry. If a certain company is in the declining stage of an industry, then you would say not only the industry but any companies in this industry is facing a long-term problem because the total demand for their products and services will decline permanently, right? Permanently. You might think it's a cyclical phenomenon, but uh, once you realize the company is declining stage, then in the future the total demand will decline for the entire industry, and the entire industry is shrinking. Sales are shrinking, net incomes are shrinking, and it's really a long-term problem that many companies cannot fix realistically in the short term. So the first thing that you needed to do before you try anything to estimate future earnings, future cash flows for a company that has negative and abnormal earnings is to look at the root cause of that kind of problems. It could be a temporary problem, it could be a long-term problem, but your solution is going to be totally different because if it's a temporary problem, then you would assume that the problem can be fixed in the near future, and you can adjust earnings, sales, and cash flows upwards towards a normalized level. But for companies that's facing a long-term problem, then you need to change your method, and sometimes you need to calculate the liquidation value of the company and to estimate the probability that the company may go bankruptcy. So at the end of the chapter, we will introduce a distressed equity valuation approach, which consider probability that the company may go bankrupt, so that we can estimate its distressed value of the corporation. So uh, here's a slide about root cause of abnormal. This is very important. Since there are many different the causes of abnormal earnings, and then after you examine those causes, then it's time for you to look at consequences of negative and abnormal earnings. Stock valuation for this type of company is difficult. It's not a normal situation that you can find a reasonably estimated cash flow or dividend, or even a normal level of cost of capital, cost of equity. And here we have three challenges that we needed to deal with when we analyzing company that has abnormal earnings. First one is it's really hard. It's really hard to estimate earnings growth rate. Why is that? Because in the most recent years, or in the most recent couple of years, company has negative earnings. So if the earnings are negative in the past, then how do you can reasonably estimate the future earnings growth? Will that continue to be negative, or another number that you can reasonably estimate? So that's first challenge. It's harder to estimate earnings growth rate, and this earnings growth rate, as you see, is very important in stock valuation, no matter which model they are going to utilize. And the second one, the estimation of earnings is even more challenged because of tax computation. And for the company that experience negative earnings, if they lost money in the past years, in the future they can carry over past losses in the future to reduce its tax liabilities. So this loss carry forward provision will add a little bit more complexity to your earnings estimation in the future. And the last one is, no matter which model they are going to use, which multiple that you're going to use in stock valuation, we always assume that a company will going forward, it's a sort of going concern assumption. We assume that a company will not go bankrupt. It will operate their business into future indefinitely, but this going concern assumption may not apply. If a company is facing a long-term problem that it cannot fix, and a company has certain probability will go bankruptcy, then this going concern assumption may not apply. So those are three challenges that we needed to deal with when we are analyzing company that has abnormal earnings. So how do we estimate future earnings for the company that has negative earnings during the most recent fiscal years or fiscal time periods? And we have two basic methods for us to do so-called normalization or estimation of future earnings. The first one is do so-called normalization work. You do not just look at last year's earnings. Let's say you look at the last 10 years earnings to see what is the average earnings growth during the last 10 years, and then what is the average level of earnings. And assume that, okay, last year, when you look at the last 10 years, and the 10 years covers a typical business cycle. Of course, company may have bad years, such as the year that they just experienced, and also they had good years. But in the future, you would expect that the company will go through another business cycle. So, if you wanted to estimate future earnings, of course, you can look at what happened in the past to see what is a normalized earning will be. So, for example, last year was negative, and the year before last year was slightly positive, and the company went through an expansion during the last 7 years. I mean, if you have the data like that, then you can look at what is the historical average in the last year for its earnings, and then you use that number as a beginning point for your future estimation of earnings. So that's earnings normalization, and we will see more examples to see how we can do this earnings normalization work. And the second method is to make an adjustment on expected growth for cyclical business, and that's the continuation of your normalization work. After you normalize earnings, you got a reasonable forecast earning for next year, then you need to estimate growth rates for the future 5 to 10 years. And here you can look at the cyclical nature of the business and make certain adjustment on its expected growth. For example, okay, company just went through one of the worst economic recessions since Great Depression in year 2008. Then for the next 5 years, what can you expect? First of all, recession cannot last forever, and sooner or later, the company will begin to recover and expand. And here you may set maybe 5 to 7 years of expansion time period for the company in the future business cycle, and to assume a high growth rates during this recovery and expansion time period. And after, let's say, 7 years, you use a constant growth time period, where growth rate will go back to normal level, which will be similar to the one that the company experienced during the last 10 years. So that's just the expected growth for cyclical business. Okay, theory is theory, and we have, of course, I mean, for the company that has negative and abnormal earnings, the key point here is first of all, examine its root cause of the problem. And the second, we apply several different approach if the company is facing different type of scenarios. Now let's take a look at two examples. First one is to evaluate a commodity companies, and most commodity companies' stock prices are closely related to its commodity prices. So the best way to forecast commodity company value is to forecast commodity prices, and we have three different ways to come up with expected commodity prices. The first one is to forecast commodity prices based on analysis of supply and demand globally, and the second one is to look at historical data to do sort of normalization work to see what is a normal level of commodity price in the future. And the last one is to look at a current commodity price, which could be very low if the company is going through a very difficult time period, or when the economy is in recession or slowing down. Then you add an option value of a commodity price to reflect the possibility that the commodity price may increase when economy recovers or when economy expands. So there are three different ways to estimate commodity prices before you come up with stock valuation for commodity company, because commodity price is the most sensitive factor determining the value of commodity stock prices. Let's take a look at one example. In year 2009, ExxonMobil. ExxonMobil is the largest oil company in the world. And first of all, we should recognize that there's a high correlation between ExxonMobil's operating income and oil price, and we can look at historical data to find that correlation. And actually, the regression for a period between 1985 and the year 2008, there's a total of 24 years of 24 years of time period, shows that every $10 oil price swing leads to 9.11 billion US dollar changes in its operating income. So if oil price increase by $10, then operating income will increase by 9.11 billion US dollars versus the rest. And let's use the bottom-up beta instead of regression beta. And here the bottom of beta would be 0.9, because if you look at regression beta, it's very likely that the beta may be underestimated for commodity company like ExxonMobil. And here you look at nature of the business, operating leverage, as well as financial leverage to come up with a bottom beta which is equal to 0.9. Then you use this number to estimate the cost of equity of this company in year 2009, where risk-free rate is about 2.5%, and the long-term bond rate, or ERP, is about 6.5%. So if those assumptions are realistic, then your estimation cost of equity would be 8.35%. And also you look at the cost of debt, and the bond issued by ExxonMobil is AAA rated, and the before tax cost of debt is 3.75%. So once you have cost of equity, cost of debt, then you can calculate the estimated WACC, weighted average cost of capital, right? Given 97% of weight on equity and 3% weight on debt. And the WACC estimation is 8.2%. We also assume that the long-term growth of the company equals GDP growth of the U.S., which is expected to be 2% in the future. And we assume 21% return on capital. This 21% return on capital would be the average in the past 10 or 20 years for ExxonMobil. And oil price in year 2008 is $86. In year 2009 is $45. As we know, oil prices are very volatile. Several years before year 2009, it went as high as $120, $40, but declined to $45 in year 2009. And we know that in year 2009, the U.S. is going through very tough time economically, and it experienced one of the worst recessions since 1930s. So low oil price reflect low demand of the economy, but as we expect that recession will be over and the economy will begin to recover and expand beyond the year 2009, then we would expect the oil price will be normalized. And what is normalized oil price? Well, in year 2008, just before the recession, the oil price tend to be a normal price, which is around $86, $87. So EBIT estimate for ExxonMobil would equal to previous EBIT, $64 billion US, minus the difference in oil price times 9.11 billion US dollars. In this case, your EBIT estimation would be 34.6 billion US dollars for year 2009. Year 2009 is year one in your estimation. Given 2% growth rate and 21% of return on capital, your reinvestment rate should stand at a level of 9.5%. Okay, since we are using this working weighted average cost of capital, then the method that we're going to utilize would be firm value approach. And the enterprise value of the company should equal to its after-tax EBIT times 1 plus G and times 1 minus reinvestment rate. What is that? After-tax EBIT times 1 plus G times 1 minus reinvestment rate will give you free cash flow to the firm estimation for the next year. And here growth rate is 2%. We use constant growth model. Then you divide this free cash flow to the firm with difference between WACC and the G to come up with estimation of the enterprise value of ExxonMobil in year 2009, which equals 320 billion US dollars. 320 billion US dollars. Then you add back cash value of the company, 32 billion US dollar, and minus the total debt, which is about 9.4 billion US dollars, and divided by number of shares outstanding, which is 4.91 billion shares. Then we'll come up with $69.43 stock price estimation for ExxonMobil. So here you see the key point here is we look at estimated oil price in year 2009. Then we estimate EBIT based on a correlation between oil price and EBIT in the past. Once we have this EBIT in year 2009, then we can estimate a free cash flow to the firm, and then use constant growth model to get estimation of enterprise value of the company. Once you have enterprise value of the company, then you can find out the equity value. That's one example. Commodity company valuation, and commodity company valuation. This example show you that when a company has short-term problem, then short-term problem may be fixed in the future, and we just needed to adjust our estimation of future earnings. Now let's take a look at another example when a company has long-term problem. And when a company has a long-term problem, analysts really needed to do a lot of hard work to identify, first of all, if company's business strategy missteps are persist or reversible. Right? And you wanted to make a judgment to see if this problem is fixable or not. If the problem can be fixed, then you use one method. But if it's not, then you needed to use distressed equity valuation method. And the second, in the case of persist strategic mistakes, a normal recovery would be unrealistic. Analysts should lower expectations substantially and consider potential bankruptcy. So if you find that a problem cannot be fixed in the short term, then you need to be realistic on the future company, which would be bad. And your valuation would involve evaluating probability that the company may go bankrupt. If the company has a long-term operating problem, then you want to identify its persistency as well. And you need to be realistic on how problem can be fixed, especially in large companies, the companies with many external constraints, the company with incompetent management teams. So it involves your objective judgment on how well the situation will be given certain constraints the company is facing, and when incompetent management teams are occupying this company, and especially this company is a large firm. So it looks operating problem could be fixed, but in those companies you really need to be realistic because the problem won't go away in the short term. And for the company that has high leverage, then you needed to make a realistic estimation on how leverage ratio change in the future. And for a company that has no immediate threat of bankruptcy, you would expect that when economy recovers or expands, or when company fixes short-term operation problem, then it's very likely that a company will lower its debt ratio, right? But lower to where? Lower towards the industry average for the stable growth time period if you use two-stage model for estimation. In the meanwhile, when a company have lower debt ratio towards industry average in the future, you also needed to adjust the cost of capital for the company during the stable time period because the beta would be lower if leverage goes lower towards industry average. And for the company that has immediate threat of bankruptcy, you need to be realistic because the company there's basically no chance the company may reduce its leverage ratio. And the only thing that you should think about is potential bankruptcy. If company is going to face certain, going through bankruptcy, then the value of company shall be calculated based on liquidation value, not a cash flow based model. You look at the liquidation value. And the second, you needed to use distressed and adjusted discounted cash flow method, which incorporates the probability of bankruptcy in your valuation. And we'll show one example how we use this distressed and adjusted DCF model to deal with the company that has probability of going bankruptcy. Okay, now let's take a look at this distressed and adjusted DCF model. And the key point of this model is we needed to estimate the probability of bankruptcy of the company. The company has lots of long-term problems. It has high leverage, and right now it's not bankrupt yet, but in the future it's likely that a company may go bankrupt. Here there's an uncertainty that you need to consider. It's not that a company will go bankrupt. Absolutely, there's a chance the company may survive. You never know, but you wanted to know the probability. So what's the probability that the company may go bankrupt? You say, hey, it depends on how bad situations are, but here you can do your evaluation to see what's the probability that company can go bankrupt. You can say, hey, there's a 50% chance company can go bankrupt, or 60% or 65%, but how you can be so sure that your number is a reasonable number, right? So here, while you are coming up with your own number in estimation of this bankruptcy probability, then another way is to look at experts' opinion, right? And some expert may be overly optimistic, other may be overly pessimistic. But you wanted to look at what's the opinion from the entire investment community. What's the average opinion of those professionals? Those professionals work really hard, analyzing the company, estimating the probability of bankruptcy, so on and so forth, and they actually put their money into this game because they do investment, and their investment based on their investment analysis. So here, we look at the market to see what the professional opinions, and those opinions are embedded bond rating as well as bond prices for a company that has long-term or short-term problems. And the probability of bankruptcy can be estimated when you look at a bond price, year to maturity, so on and so forth. And also the probability of bankruptcy can be estimated based on bond rating. Certain bond, certain bond rating will indicate the probability of bankruptcy. And table 22.1 showed you, for bond that has different credit rating, the probability of bankruptcy is different. And for highly rated bonds, that probability is very low. But for the bond has low ratings such as triple C, single C, then you will see what's the reasonable probability of bankruptcy on the table. But keep in mind that the probability of bankruptcy based on bond rating is a time variant, which means the probability numbers will change time to time. And a more reliable method for you to get a probability of bankruptcy is to look at the bond price. Once you have this probability, then the value of distressed equity equals the company with the going concern assumption, assuming that the company will survive, right? If you assume the company will survive, then you estimate the value, and then the value of this distressed assets equals equity with the going concern times 1 minus probability of bankruptcy, or simply you multiply this equity value with the going concern assumption with its probability of survival. Now let's take a look at one example to see how we use this stress DCF model to estimate a company that has certain probability of going bankrupt. An example is MGM in year 2011. It's on page 634 and it's in illustration 22.8. And MGM had EBIT 1.4 billion US dollars and a net income 1.6 billion US dollars back in year 2002, which is a pretty normal year for the company when economy actually expanded after dot-com bubble in year 2001. So year 2002 is a very typical economic recovery and expansion time period. But in year 2008, as we know, the U.S. economy got into huge trouble. It was so-called Great Recession in year 2008. EBIT of the company declined to less than 400 million US dollars, and the net income is a huge negative, a little over 1.4 billion US dollar losses. And also, the company has high leverage ratio of 60%. It's higher than industry average of 46%. So that's basic information about the company MGM in year 2011. Now, let's do a little forecast on this company regarding what will happen in the future. Well, the company just went through really nasty economic depression, recession in the economy, but this recession is about to be over, and the stock market began to rebound actually in after March of year 2009, and so economic recovery is on the way. And in year 2011, we would expect that this recovery will continue, and economic expansion is expected in the next couple of years. So we could assume 6% growth rate in year 2011, followed by 15% growth for the next 4 years, and then a stable growth time period with growth rate of 3%. That's our assumption on future growth, given consideration of this business cycle. And the second, we also assume that that ratio will be lowered from the current 60% level to industry level average of 46%. Regarding operating margin, current margin is low because economic condition is bad, but we could expect that operating margin will be improved from 6.3% to 20%, which is industry average. And in the future, we need to calculate free cash flow to the firm. In this case, we wanted to see what is a realistic investment rate, and this investment rate should achieve 30%. In order to sustain 3% long-term growth and a 10% return on capital, and 10% return on capital is our assumption. And based on all those assumptions, then we can use, let's say, a modified two-stage model. First one is high growth time period, then followed by stable growth time period, and you can look at the illustration 22.8 to see the details of that two-stage model. And the stock price estimation would be $22.77 based on this two-stage model. And this two-stage model assumes that a company will go forward. It will not go bankrupt. However, this company has certain probability to going bankrupt. So we needed to discount this stock price based on going concern scenario to get distressed stock price. Now let's take a look at the probability of bankruptcy. If company goes bankrupt, then what will happen to stock price? Stock price will equal to 0. Okay, but here we want to see what's the probability that stock price will go down to 0. And the approach that we are going to use is to look at the bond price. And unless the company has a bond, tradable on the market, principal value $1,000, and the coupon rate is 7.625%, which means the annual coupon payment is $76.25. And this is a 10-year bond, and current year to maturity is 3.5% on market interest rate for similar bonds. And then we can apply this equation to figure out the probability that the company will go bankrupt. We multiply cash flows with 1 minus P. P is the probability of bankruptcy, right? And then we solve this P in this equation. You can use goal-seeking function in Excel spreadsheet to solve for this P. And I think that's the most convenient way for you to find the answer of P. Use goal-seek function in Excel. Mathematically, it's really hard for you to solve this P, even when you use calculator. And then you multiply stock price on a going concern with 1 minus the probability of bankruptcy to get distressed company stock valuation, which equal to $14.71, which is very close to the stock price of MGM in year 2011. So this is a great example showing you how to use this probability of bankruptcy in distressed DCF model. Okay, that concludes this chapter. This is although it's not a long chapter, but I really want you to pay great attention to those illustrations to see how we use distressed model and how do we set up a series of assumptions. Those assumptions need to be realistic, which is based on your analysis of the economy, analysis of the industry, and analysis of individual companies. So from those illustrations, it also reminds you that what we learned in this class is just a toolbox, right? But what you need is not just a toolbox. You wanted to have full set of skills that can help you to fix all kinds of stock valuation by using those tools, right? Of course, you use tools. On the other hand, you wanted to have a really good understanding of the business the company is doing, right? How economy looks like, how business operates in certain state of economy, and how company compete each other in certain industries. So you really wanted to expand a little bit from this toolbox to business analysis. And this textbook, this class, are all about this toolbox. But you should train yourself, or take great opportunity to do the real stock valuation, like the one that we will that we go through in this valuation project. Because in this valuation project, of course, you apply this principle, but more importantly, you look into the full set of information about the company, which is in 10Q, 10K, all the financial numbers that you can analyze in capitaliq.com, and everything that you needed to do has to do with your understanding of the business in this in certain industry and in certain companies. So illustrations are important, especially the process where you set those assumptions that actually reflect how well you understand the business in certain industry and certain companies. Once again, I wanted to quote something that Warren Buffett said. Warren Buffett said that stock analysis is not about financial analysis. It's about business analysis. Well, in this class, we learn all the details of financial analysis. But in order to deliver a great job of stock valuation, you also needed to do a thorough business analysis, like what Warren Buffett said. So this valuation project gave you great opportunity to train yourself on how to improve the skills in business analysis. Business analysis is all about understanding what the company is doing. what company is achieving and what company's strategies are in the competitive landscape of their industry. Okay, so this is chapter 22, how to evaluate companies that has negative and abnormal earnings. And at this point, I would expect you guys to practice the questions problems in your third exam. I hope you enjoyed this video, and I will see you in the next one. Thank you so very much.